Welcome to our deep dive into investment risk. We'll explore the two main types of risk and how to evaluate your returns against the risks you take. Investments are exposed to two broad categories of risk: company-specific, known as unsystematic risk, and market risk, which is systematic risk. Company-specific or unsystematic risk is unique to a single company. Think of issues like management failures or product recalls. These risks arise from factors specific to a particular company and only affect individual securities. The good news is that unsystematic risk can be substantially reduced through proper diversification across different companies, sectors, and industries. Next, let's look at the other major type of risk: market or systematic risk. Systematic risk originates from macroeconomic factors that impact the entire market. These include inflation, interest rate changes, economic cycles, and geopolitical events. Unlike unsystematic risk, systematic risk cannot be eliminated through diversification because it affects all investments in the market. How do fund managers handle these two types of risk in practice? Fund managers actively reduce unsystematic risk by constructing highly diversified portfolios, which is a core principle of good investment management. Finance theory dictates that investors are compensated only for bearing systematic risk. Active fund management involves taking calculated, unsystematic risks to outperform benchmarks. It's crucial to understand how risk is transferred to the investor in mutual funds. The regulatory disclaimer reminds us that mutual funds are subject to market risks. Investors bear the risk of the underlying securities, and net asset values, or NAV, fluctuate with market conditions. Evaluating investments isn't just about the returns, it's about the risk taken to generate those returns. That's where risk-adjusted return measures come in. Since higher volatility implies higher risk, risk-adjusted return measures help you compare different schemes on a like-for-like basis. The Sharpe ratio measures the excess return generated per unit of total risk using the standard deviation. A higher ratio indicates better risk-adjusted performance. The Trainer ratio focuses on systematic risk, measuring excess return per unit of beta. It's most relevant for well-diversified equity schemes. The Information ratio measures the fund's excess return over its benchmark relative to its tracking risk. It reflects the fund manager's skill and consistency. Finally, let's touch upon the importance of scheme benchmarks in mutual fund evaluation. Benchmarks provide a clear reference point to evaluate a scheme's performance. A credible benchmark must align with the scheme's investment objective and strategy. SEBI mandates benchmarking against the Total Return Index, or TRI, which includes dividends and interest income for fair and transparent performance comparison. Understanding systematic versus unsystematic risk and using risk-adjusted return metrics is vital for making informed investment decisions. Always read the scheme-related documents carefully before doing your investments.